All right, happy Tuesday, everyone. Dan here with Tradingology.com, where retail traders learn how to trade with confidence. And with us today, as usual, we do have Dave joining us, so I'll bring Dave on here with us. Dave is the founder of Tradingology. Oh, what year did you actually start, Dave? Probably 2007 or 8, if I would think about it, way back when. So he's been here a long time. He's also helping and running the crews over at Strong Market that we're going to talk a little bit about today. So today we want to talk about a tool that we use, but good to see you, Dave. Happy Thursday to you.
Yeah, happy Thursday. Good to see you too.
And we are coming live to you guys, so if you got any questions along the way, definitely hit us up in the comments. We'll try and keep an eye on those, and then kind of bounce ideas off you if you guys got any questions that we're talking about as we go through here. So happy to see you, as for sure. So Strong Market created the market timer, you and the team, way back when. So let me pull over or introduce that guy here. And let me know if you guys can or can't see this decent. Greg says good morning. All right, thanks, Greg. Appreciate you joining. So thanks. If we sound funny, let me know. If we're too quiet, this is a new deal we're testing out here. So let us know if the audio video is kind of funny at all too. So appreciate it, bud.
Yeah, good morning, Greg.
So this is the market timer spreadsheet. And let me ask you, Dave, where did the thought of this come from? What was the origin of this spreadsheet?
Well, I've been trading since 1974. The very first trade I made was on my father's account. I was only 16 years old at the time, and I got hooked on the market on my very first trade. I made $600, and I used it as a down payment for a motorcycle, which was not a very smart move financially because I bought a depreciating asset. However, I was hooked on the market from that point. And when I got into my early 20s, I started researching the market even more. And I decided that I was going to pursue it as a part-time hobby at that point. Because in my early 20s, I was still in school. And then I ended up going to seminary in Boston. I got out. And my very first job was selling computer equipment, actually very expensive computer equipment for the time. This was back in, oh my gosh, probably 84, 85, and 1984, 1985. God, it sounds ancient now. But I was selling $30,000 computers for this company. And it just wasn't going anywhere. So I ended up getting a job with a nonprofit doing something called job development. What that did was it gave me a lot of opportunity at nights to study the market and over the weekends. I got married, had my first child, and I said, I really need to boost up my income. And I had some savings at that point. And I ended up moving to Boston. And I started to listen very closely to the Financial News Network on TV, which is a precursor to CNBC. And there was this guy who ran a hedge fund very early. I mean, this is kind of early for hedge funds, but it was one of the earliest hedge funds. And he said he had a proprietary system for determining market direction based on market internals. And he didn't go into any details, but it sparked my imagination and it sparked my curiosity about what he was talking about. So I ended up getting the Wall Street Journal printed edition every single day. And I went through the market internals, which was in fact, if you scroll over to the left side of the spreadsheet there, you can see that this is part of what is included in the market timer is the NYSE advancing issues, the declining issues, the up volume and down volume. And this is public information that was printed in the Wall Street Journal. And now you can find it on the Wall Street Journal website. And so for anybody who has a spreadsheet, they can just plug in those numbers and the spreadsheet, it's automatically, everything else is automatically updated. But those were the four key components. And what I did was a correlation coefficient with the changes in the S&P 500 on a daily basis. And what I found was a high correlation between the ratio of the advancing declining volume, up volume and down volume in a formula that I created really at the time now it's an algorithm that determined whether or not the S&P 500 was going to make if it was the changes in the S&P 500 were correlated with the market internals. And then so what I did was I said, hey, look, there's the correlation coefficient at the time, which has remained constant since 1992, is a 90 plus positive correlation. And if you understand anything about correlation coefficients, you realize that the closer you get to a +1, the higher the correlation is. And if it's a -1, it's an opposite correlation. It's a negative correlation. It's kind of the reverse. And so it had a very high positive correlation to the changes in the S&P 500. And that's actually, even though we list the Dow changes on there as well, we use that in a different way on the spreadsheet. But it's the spreadsheet itself was based on the changes in the S&P 500, and that's why we highlight the change there. And that's kind of like, so that original formula that I was working on my kitchen table in Boston, I had this is pre-computer days. This is before I had a computer, and computers were the size of rooms back then. They were just gigantic. So I had lined paper. I used graph paper to use, and I used physical spreadsheets. So I was actually writing all that data using a calculator to do my calculations for the algorithm that I came up with to determine whether or not the day when it had finished, the end of the day data, correlated with the changes in the S&P 500 at a 90% level or better. The days that it did not correlate, I called an anomaly. That anomaly gave me a heads up on what would happen the next day. For example, if the correlation fell to like 60%, I realized that the market if it was a plus day, if the market was up that day, I realized that the market at that point, not having a 90% correlation meant that it had overextended itself. So if it was up, back in the day, if it was up 3 points, it was a big deal. It was a big move. And I realized that probably the next day we would probably decline because the correlation did not hold up for that day. It wasn't 90%, it was only 60%, which means that it probably we would decline the very next day. And I would buy puts on the OEX, which is the 100 index at the time. I think the OEX actually is still around, I'm not sure. But anyway, today we use the Dow changes and we use the AD column, which is the price anomaly, to give me the same idea. It tells me what the anomaly is for the price changes for the Dow and the S&P 500. There's a tremendous correlation between the S&P 500 and the Dow. But the Dow numbers, the changes in the Dow numbers were highly correlated to the anomaly. So that's why we're using them. And that's really how it started. I started trading it part-time from the early 90s, and I've done the correlation coefficient over the years, and it hasn't changed. Even though the S&P 500 has gone up, it has nothing to do with the number of stocks being traded on the S&P 500 or the NYSE at any one time. It has nothing to do with the price levels. It has nothing to do with the changes in the Dow calculations. So, for example, the number that they use to determine the changes in the Dow stocks has changed dramatically over the years. I forgot what you call it now. It's the Dow multiplier. And what happens is, the multiplier was like at 1. So every time a stock in the Dow went up, there's basically a 1-to-1 ratio in the changes in the Dow. So if it went up 10 points, it means the net move of all of the Dow stocks was 1 point or 10 points. Rather. And then, but over the years, that multiplier has gone from 1 to 0.87 to 0.76, 0.66 to 0.10. And a lot of people, and actually it's quite true, is that the Dow really hasn't gone up that much. in real terms, over the last 20 or 30 years, they constantly change out all the stocks that are losers and they replace them with different stocks. And so it's really an illusion to think that the Dow has actually gone to 36,000 now, because the multiplier is down to like 0.10 or something. It's like, so now all of the moves are exaggerated. Like a net 5-point move in all of the Dow stocks added together, taking the pluses and minuses, is like a 500-point move. It's ridiculous because the multiplier is so low. Anyway, that's how it started. 1992, correlations have been constant, has not changed. The correlation coefficient remains 90 plus. So it remains a very viable way to determine market action and whether or not the market's going to be up or down either the next day, or you can determine trends, swing signals, all the ways that we use the spreadsheet.
Very interesting. And so you obviously created multiple algorithms.
Yes.
Let me know if that sounds funny. It sounds funny to me. I'm hearing a little echo, so it'll fix. There you go. It's fixing itself. Just keep talking. They fix itself. Yeah. So lots of algorithms in there.
Yeah. So I started with the original algorithm that only took the market internals and created that original algorithm. Back in 2007, 2008, as you mentioned, 2009, 2010, 2011, I dug in much, much deeper on the original algorithm, and I started creating what would be considered a neural network based on the original algorithm. So I was taking a second level, third level, a fourth level calculations based on the original algorithm to make further improvements in the system. And so the great growth in this particular spreadsheet, the current iteration, happened between 2008 and 2018, I think was the last iteration of the spreadsheet.
And then from there, we know today you use these. So the spreadsheet is still valid. It's still a way, people that like to read spreadsheets still do that. And it's where everything is derived from. Those were then also ported into live algorithms to be used inside of trading platforms. For example, here I have a Thinkorswim, and this is the original Market Timer XL, which shows those internals. So the green and the gray lines are related to the advancing issues and the advancing volume,
right?
Versus the yellow and the pink here that are showing the declining volume and issues. So we can watch over time, what is the day doing? So we see when there's the majority of the market is being bought or the majority of the market is being sold. So I think that was one of the greatest things that were done from the system, is taking the spreadsheets and building them into live things that traders can leverage. So it's a very interesting theory to watch. And then, so the very basic one here is simple. It continues on. So we see there is, as I scroll this over to the right back on the spreadsheet, those 4 issues that it shows on that indicator that we have. But as you say, the layers upon layers of different things. You've created the pipeline, the balance of power, which shows bullish and bearish herding. And I have this, a couple of years ago, I just opened up the spreadsheet, 2019, 2020, because I'm sure people are going to say, well, does it accurately predict things? What does it do? So leading into the pandemic, which I think, when was the drop? February, March? I think it was like February 20th, give or take.
Yeah, it was toward the middle to end of February.
So as we look here, we're the end of January, we see the pipeline in what is called the flow column here, definitely alarming, while what is called market timer volatility, which is also derived from that core spreadsheet, going from the 70s up into 80s, straight through to 90s, and then we see it a couple days in the hundreds. This is before the major drops were happening. Yeah, we had a 400-point move here, a 600-point move, but this was pre-pandemic announcements before the markets freaked out, right? And the bottom just fell out.
Right. And just to and that was a really good explanation of how we kind of view it. One of the major updates to the spreadsheet was the visualization of what's happening in the market. How many participants are bullish, how many participants are bearish. And that's what the bullish herding and the bearish herding are all about. Market participants herd, just like any other animal. When they're afraid, they tend to run. When they're calm, they tend to just graze and kind of go along on their merry way on a bullish path. And that's what the bullish herding and the bearish herding represent on a visual basis. So you can take a look at who's in control of the market. You can just with a single glance, you can say, okay, it looks like from 1820 to 124.20 or 23.20, bullish herding was dominant. Okay, so there were more participants that were bullish, that were buying. Now, this is an important part. This is not theoretical. Those ones in the columns indicate a section of participants who are putting money into the market on the bullish side, on the bull side. That it represents dollars and cents of people who are putting their money, not just talking about, like if you go on CNBC, people talk about, oh yeah, I'm bullish on the market, and this is, but we have no idea where they're putting their money. This is actually representation of money being put into the market on the bullish side. On the left side, it says bullish herding. On the bearish side, it's participants that are bearish that are actually selling stocks or selling short. And so when they start to cluster, the more columns that are filled out across reading, just like you do in reading a book, you're going from left to right. The more columns that are filled out, the more bearish people are becoming. More bearish the participants in the market are becoming, and this is where they're putting their market. They're either selling or they're selling short. And so you can look at a single glance and say, oh, wow, it looks like more people are participating on the short side or selling their positions. Now, the pipeline was developed after the bullish and bearish herding came into play because I wanted a heads up. It gave us it's kind of an early warning system of what's coming down the pipeline. Is it going to be selling or is it going to be buying? And you can see right on the 22nd, on January 22nd, 2020, we had a 92% in that third column of the pipeline. They gave us a heads up that there was some major selling coming into the market. And just after that, within a couple of days, we had a 170-point drop, we had a 453-point drop, and then a few days after that, we had the 603-point drop. So all of just like reading a book, typically what I'll do is when I read the spreadsheet, I'm going from the left to the right. I'm looking at the date, the average volume, everything in between from that black column. Demarcation of the primary data is to the left of that. Everything to the right of that is what I look at when I analyze the current state of the market based on the market timer system. I'm going supply, demand, price anomaly, market timer, the volatility, the pipeline, the flow, the bullish herding, BOP curve, right across all the way to the LT signal and the comments. The comments is the last column. So the bullish and bearish herding is a visualization. The pipeline is telling me what's coming, and that's how we analyze the spreadsheet, and it works. Like I said, since 1992, it worked. It's called almost every single market drop, every single market advance since then on a swing basis, on a long-term basis as well. So let's see what happens after this. So we've got the pipeline increasing, and we've got bearish herding increasing, and then all of a sudden we come back and we've got a little bit of a stabilization here. But if you look at the bullish herding, you can see how spotty it is. I call it spotty herding, and that is that we had some participants coming in that are, bullish, but they're not overly bullish because they didn't fill out all of the columns. So we get real solid bullish herding when all the columns are filled out. But as you can see, there was a lot of spotty bullish herding during that time period, and the market really didn't hold up very well.
And then we see 100% hit, and then all of a sudden we see the bearish herding coming in, while the pipeline and the flow are definitely turning red, and then the big drops really happen. So if I bump this up, right before that happened, this is definitely a warning symbol, right? So
Yeah, well, we had the two middle columns of the pipeline gave us the first heads up. So I look at the three columns just before that. They were all white and blue. Blue means it's really, really low. So very, very little selling. And then all of a sudden, it went from 67, 67, 79 to 93 and 96%, which means that there was a lot of selling coming into the market.
So we want to be able to see it, right? So this is why that Dave has created this visualization. You can see it coming before it happens.
Right.
So it's not an intraday thing. It's like, hey, this is major potential, what's happening. And then then we had the 1,000-point days. And then the full bullish herding, or excuse me, the full bearish herding.
Right.
In the bear, we saw everything was selling. We had 3,000-point drop in 4 days. So kind of the long and the short of it there is, you created the coefficient, and then you wanted to be able to see it easier instead of just reading numbers. And a lot of members are visual. So I believe, correct me if I'm wrong, but this is a creation to help members in Tradinology, and that you've helped over the years teach how to trade, how to visualize what's going on versus just trying to read numbers. Because if you go back over here, I mean, you can derive the same thing if you are an analytical person and can just look at numbers, say, oh yeah, we had a lot more of this than that. But what does that mean? So that's where creating the different algorithms that layer on top of each other and what's working makes it so much easier for the human eye to say, oh yeah, okay, now I see what's happening. Here's where the herd's moving.
In fact, the original algorithm, if you go back to column B, or P rather, P as in Paul, P, Q, R, T, U, V, those 6 columns are the results of the original algorithms, the ratios of the advancing issues in the up volume and the declining issues in the down volume and the sequence. And so you can kind of tell if you're kind of an analytical person and you can just look at those numbers, you can see when the market is overextended, like on row 1031 there, we were at 79% up volume ratio, the up V ratio there. And you can kind of get an idea, well, that was probably a little bit overextended. It means 80% of the market, 80% of the volume that day was going into all those up issues. But at the same time, the number of shares going up was only 72%. The next day, you see the volume really came down. The volume ratio came down to 72%, and the up share ratio was 76%. So there was more shares going up. Well, that kind of led to what happened on it was the second, February 7th there rather. And it just means that the market was overextended. When 80% of the volume on a single day is going into stocks that are advancing, there's not much room for it to move. It could go to 90%. I've seen some days where 90% of the volume is going into the up issues. But generally speaking, that's the time to get out, not to get into the market because it's already overextended. Hey, Andy's in the room. How's it going, Andy?
Yeah, we got our old friend joining us, so it's great to see you. So that's just a short, just very quick, hey, what was created? We want to give some background on that since we do have a lot of new people that are coming in here as we're starting off this new platform here and launching people and the members getting used to the new groups and whatnot. So we wanted to give a little overview of one of the tools that we use in our trading, what it is, why it was created way back when. And then in our programs, we definitely teach people how to use it. What's the best ways to go across this? Yeah, market's certainly doing crazy things. He says, yeah, so this is our insights into what's actually happening via the internals, right? So that's what we kind of leverage these in our, I wouldn't say necessarily specific short-term day trading, but at least it gives you a bias on where the market may go to see what's actually going on. Headlines are one thing, internals are what's actually happening, where orders have been placed. So it doesn't lie. It's literally just built on data.
Yeah, the real benefit of the spreadsheet is really for the person who either has a long-term investment account portfolio or is a swing trader. Specifically, I use it for swing trading. It's absolutely fantastic for swing trading because you can get that heads up. Hey, look, what happened today? Does, for example, on 214 and 218, we had two bullish hurting, but they're out. They're far out. So, like I said, we look at it from left to right, and actually the left column, the first column on the bullish side, is the most important column because it shows what's currently happening in the market. The ones, if you go farther to the right, it's more distant. You can think of it as like fading bullish hurting, which means there's not a lot of participants, especially if the first column is not filled in. So we had that fading bullish hurting there, and that indicates to me that the bulls have really kind of stepped away from the trading environment, and they're not jumping on the current trend higher. And so that left open the door for the bears to walk in. And that's kind of what I look for all the time. I look for that constantly. And then we had the pipeline. I mean, we actually had a lot of signals. I mean, if we go from left to right during those 2 days, we had starting on the 13th, we had a huge number we had the supply demand going down. It was -2, and that the supply demand actually, what it does is it measures the what it says is the supply and demand. Is it positive or is it negative? And we had a -2, we had a -2, and then we had a -1 going into that +2. And we also had there was not much in the price anomaly. The price anomaly, we have a specific system that we use to determine whether it's significant or not. MT volatility, however, during that same period was rising from 94 to 95 to 97 to 99, and then it hit 105%. MT volatility means that when it hits 100%, the bulls and bears are equal. As soon as it hits, and if it's rising, it means there's more sellers coming into the market than buyers. When it hits 101%, that means there's more sellers than buyers. So as soon as we hit that 99%, you can tell it was rising from 94, 95, 97, 99. It means that the number of sellers coming into the market was rising dramatically. And as soon as it got over that 100%, there were more sellers in the market than buyers. And that was a pretty good clue that we were going to see a sharp decline in the market.
Fantastic. Then the last thing I'll leave you with, we can have another revision on this, is people do like reading spreadsheets. Absolutely. There's a lot of people that do that. But as we saw in the very first correlated, or I should say derived algorithm of the original Market Timer XL, is the strong market team that Dave has worked with over the years created a lot of these indicators to be able to be read live in Thinkorswim or a few other platforms. So that bearish hurting, we can see inside of Thinkorswim, supply, demand, strength, the balance of power. So lots of things have been derived and created into algorithms. So if this is the first time you're seeing it, definitely it's not just a spreadsheet thing. It's a thing that you can watch intraday or use it for like you say, your swing trading and whatnot. It's the way that we leverage that inside of our tools.
Yeah, absolutely. And shout out to Andy, who was leading the programming on a lot of those indicators. So shout out to Andy for the work that he did on those. It was absolutely fantastic, translating the algorithms into the Thinkorswim scripts.
Yeah, Andy's one of the developers that we use. So we have a few developers. So yes, thank you. I totally almost forgot about that, Dave. So appreciate bringing that up. Andy, I believe, is still with us. So your work lives on, sir. Thank you very much.
Absolutely.
And if you're not that this is a sales pitch at all, but some people, okay, how do I get my hands on it? Excuse me. Got a frog going on there. You can definitely hit us up if you're members, let us know. But anybody that's brand new, you can subscribe to it. It is a service. You can get it one time, or we do update it. So MT for Market Timer .strongmarket.com is where that is available. So just a quick little clip there for you if you guys are looking for it. If you don't have it yet, there's where you can find it. So we're going to continue these guys once a week at least, and then we will be got another secret coming out for you guys that are members. So look for that probably in an email. We'll announce it in the email what's coming there for you guys that are existing Tradiology members. So we appreciate you guys coming out. Any final questions you guys got out there? We appreciate you guys coming on live. I see we definitely have still a few viewers. Greg's out there. Appreciate it, Greg. Greg definitely says thanks, Andy. So show Andy the love, everyone. Andy was a great guy helping us out, creating those algorithms derived from the information. Great work. Any parting thoughts, Dave? I don't see any new questions coming in. I will keep an eye on it though. But
I would just say, look, if you're interested in participating in the market, you have to really understand what drives the market. It's not the talking heads on TV. They're talking their book. Okay, so talking their book just basically means that they have a position in the market. Sometimes they disclose that. Sometimes they don't disclose that. But they always have some bias in the market because of the positions that they currently have. A lot of times they'll also throw off investors by saying one thing, saying, oh yeah, this is a great opportunity, but at the same time, selling as the stock is going up. So if they think a particular stock is a great opportunity, people come in and jump in and buy it. They're selling on as other new buyers come in. You have to be really careful. I think the SEC has their hands full, especially with everything that's going on with apes today and the meme stocks and everything else that's going on social media with all of the changes that are going on there, especially with retail participation in stocks. But all of the other people, like there's a lot of people that are still on CNBC that have been contributors for a very, very long time that are also talking their book. So you have to be very conscious about what's going on. I guess my final and parting advice is don't look at what people say, look at what they do. And the only way that you can actually tell what they do is by looking at the market timer spreadsheet, because that gives you a day-to-day update on exactly who is putting money on which side of the market, either the bulls or the bear side.
Absolutely. With that, we will call it a wrap for today. As always, appreciate your time. Thank you, everyone, for coming out. Thanks, Andy. Thanks, Greg. You guys have a great weekend. We will catch you next week.
All right. Thanks, Dan. See you guys.